Let's get a look at the state of the energy markets and the outlook for 2025. Let's welcome Daan Struyven, Goldman Sachs co-head of Global Commodities Research. Daan, great to have you with us.
Thanks for having me.
Oil is headed for a modest drop for the year, and I'm wondering, in terms of the geopolitical and the economic factors, what is the biggest driver here? Is it China demand not coming back? Because the U.S., obviously, we're sort of keeping up our end of it in terms of a decently, strong economy here.
Yeah, so we were looking for a modest deficit in 2024, and that's basically what we got. I think what has changed is that the risk premium has sort of turned from pretty positive, with markets focused on downside risk to supply in Russia and the Middle East, to a market becoming more focused about a potential oversupply in 2025, and the risk premium actually dropping and turning negative. So in other words, the fundamentals have been broadly in line, with inventories levels edging down slightly, but I think market sentiment has really shifted and turned more pessimistic from a price perspective.
What are you looking for in 2025 in terms of the price of oil, and what sort of the hot spots that the decisive factors will be for the oil picture?
So in our base case, Brent oil prices stay close to current levels in the mid-70s, with sort of OPEC protecting 70 as a floor and high spare capacity limiting the upside. But I do think that the risks of breaking out of this range are growing somewhat, in large part because of potential implications from the new U.S. administration. In the short term, we see the risks as skewed to the upside. If Iran supply were to fall more than our base case, where we look for a modest decline because of tightening sanctions, that could cause a spike to sort of the mid-80s from a Brent perspective. Over the medium term, though, we do see the risks to oil prices as skewed to the downside, both because across-the-board tariffs, not our base case, could weigh on oil demand, and also because high spare capacity may imply a faster and more significant return of barrels to the market.
So when you talk about the policy implications from a new administration, it's mainly the tariff situation. It's not necessarily the regulatory forces here at home for drilling, because what we've seen is that oil prices actually come down when there's more, right, when you have a looser drilling policy.
So the two areas of U.S. policy that we think are the most significant potentially for oil prices are on the supply side, sanctions and the possibility of significantly lower Iran supply. In 2018, 2019, under the first Trump administration, Iran exports dropped by more than 2 million barrels per day. And on the demand side, we do think that the most significant policies are potential tariffs, which could weigh on global GDP and therefore global oil demand. The impact on U.S. production, we think, is going to be fairly modest, especially in the short term.
Right. In terms of gold, what is your outlook for gold? I know we called you here for oil, but gold is a hot investor topic. People want to buy it at Costco, so obviously there's great demand retailing.
Yeah, gold continues to be our favorite long commodity. We see gold prices rising through $3,000 per troy ounce by the end of next year. That's an additional 14-15% of upside. The main structural driver of this bullish forecast is that central bank purchases have increased by a factor of 5 relative to the pre-2022 average, because central banks basically woke up when Russian central banks' reserves were frozen by wondering, hey, are my assets really safe? Should I diversify into gold? And then on the cyclical side, we also look for some additional price support from the gradual boost to demand for gold from ETF holdings because of lower federal funds rate.
But all of this will offset even the strength in the dollar, which is called for even increasingly in 2025, as the central bank differentials continue to increase?
So in our view, a stronger dollar for longer is not going to prevent gold prices to rise to $3,000 per troy ounce by the end of next year in our base case, because we actually find that ETF demand depends on the level of U.S. rates as opposed to the dollar. And second, if you look at central banks, the biggest driver of additional demand, and if you, for instance, look at China, periods of currency depreciation in China, so dollar strength, have actually been associated with stronger gold demand from the central bank, as the central bank tries to provide confidence to the currency markets by supporting the currency with gold purchases.